Have you ever wondered why smart investors don't put all their eggs in one basket? Why do they insist on diversifying their money? This is because diversification is a key strategy in managing risk in the world of investing. It involves spreading investments across a variety of different options to potentially yield higher returns and lower the risk. Think of it as a financial safety net, ensuring that if one investment falters, others can still thrive. In short, diversification is like spreading your bets to maximize gain and minimize potential loss. Now let's break down the concept of money diversification into simpler terms. Imagine your financial portfolio as a meal plan. You wouldn't want to consume just one type of food every day, right? Variety is key. Each food item provides different nutrients, contributing to your overall health. Similarly, diversifying your money across various investments ensures that your financial status remains robust and well-rounded. Just as relying on a single food type can lead to nutritional deficiencies, depending on one investment can be risky, the financial market, much like our health, can be unpredictable. If one investment fails, it can be catastrophic if that's where all your money rests. But if you've spread your investments, the impact of one underperforming asset can be counterbalanced by others. So, just like a balanced diet is important for our health, diversification is crucial for our financial health. But how does one diversify? What assets can be considered for this strategy? Here's where precious metals like silver and gold, and digital assets like Bitcoin come in. Precious metals, especially gold and silver, have been valued by civilizations for thousands of years. In times of economic uncertainty, they're considered safe havens. Why? Because they hold intrinsic value. They're tangible, finite resources that cannot be inflated away by government policies. Now let's talk about Bitcoin. Bitcoin is a digital asset, a new player in the diversification game. It's decentralized, meaning it's not controlled by any government or corporation. This trait gives it potential as a hedge against inflation and economic turmoil. It's like digital gold. So, how do these fit into a diversified portfolio? Well, they can serve as a buffer. When traditional assets like stocks and bonds are in a downturn, precious metals and Bitcoin could perform well, balancing out your portfolio. Remember, diversifying your investments across different asset classes like precious metals and Bitcoin can help cushion against market volatility. It allows you to weather the ups and downs of the market, thus securing your financial future. To sum it up, diversifying your money is not just a smart move, it's a necessity. It's like creating a financial safety net, reducing the risk, and maximizing the potential for growth. Assets like gold, silver, and Bitcoin play a significant role in this strategy. They offer a hedge against inflation and a safe haven in economic uncertainty, so diversify your financial portfolio and set yourself up for a prosperous future. Moving on from precious metals and Bitcoin, let's not forget two other crucial components of a well-diversified portfolio: stocks and bonds. These traditional investment options have their unique advantages. Stocks, or shares in a company, offer the potential for significant growth. They allow you to benefit from a company's success via increased valuation and dividends. On the other hand, bonds or debt securities provide regular income and are generally more stable than stocks. They're essentially a loan you give to a company or government in exchange for periodic interest payments, and the return of the bond's face value when it matures. The beauty of having both stocks and bonds in your portfolio is that they often perform differently under the same market conditions. When stocks are doing well, bonds may not be, and vice versa. This counterbalancing act helps to manage risk and enhance returns. So, as you continue to diversify, remember to include stocks and bonds in your strategy. They are the bread and butter of any well-diversified portfolio, offering a blend of growth, income, and stability. Stay tuned for more financial wisdom. As we conclude, remember that diversification isn't just about owning different types of investments, but also about balancing them in a way that aligns with your financial goals, risk tolerance, and investment timeline. It's about having a mix of stocks, bonds, precious metals, and digital currencies like Bitcoin. Each of these asset classes brings something unique to the table, and together, they can help create a balanced and resilient portfolio. To effectively diversify, you should regularly review and adjust your portfolio as needed. This might mean rebalancing to maintain your desired asset allocation, or adjusting your strategy based on changes in your life or financial goals. And remember, diversification is not a one-time task. It's a continuous process that requires regular attention and adjustment. Finally, don't overlook the importance of patience and discipline. Diversification is a long-term strategy, and it's critical to stick with your plan, even when the market is volatile. After all, the goal of diversification is not to maximize returns, but to mitigate risk. Thank you for watching. This is Prosperity Pulse, your guide to financial wisdom. Don't forget to subscribe and stay tuned for more.